Okay, so we're opening up the vault today, really going back in time. We're looking straight at one of the most, well, powerful financial documents you could read, Warren Buffett's 1977 shareholder letter.
It really is something. And we've got sources detailing, his crucial advice from that specific year. It's basically the blueprint for how he built everything.
Yeah, and what's wild is 1977, Berkshire Hathaway's profits, their earnings per share, they jumped, what, like 37%? Huge number.
Massive. You'd absolutely think the letter would just be, a big celebration lap.
But nope. The sources show Buffett did the exact opposite. He used that success almost as a teaching moment, telling everyone, including you listening, why that huge number could actually be pretty misleading.
Exactly. So our goal today really is to take those foundational lessons he laid out about efficiency, how to use capital, picking the right industries, and just translate them into clear, usable rules.
Right. This deep dive is about giving you the tools to sort of cut through all the financial noise you hear today and judge a business the way Buffett did back then.
Yeah, stripping away the jargon.
Okay, let's jump right in then. The core argument. Why most companies, even today, love to brag about the wrong number. That headline grabber. Record earnings per share, or EPS. Sounds great, right?
Sounds fantastic. But Buffett was, let's say, deeply skeptical of focusing just on that number, especially in the context of 1977.
What was going on then that made him so cautious?
Well, you have to remember the economic climate. Inflation was really high back then, so just looking at nominal dollar amounts, well, it didn't mean much if the actual buying power of those dollars was shrinking fast.
Ah, okay.
Buffett was hunting for proof of real wealth creation, not just bigger numbers on paper. He famously called rising profits on their own just math, not skill.
Okay, hold on. I can hear people thinking, but wait, if a company makes more money than last year, isn't that good? Why wouldn't investors care if profits go up?
It's a fair question. But think about how profits usually rise in established companies. They generally keep or retain a big chunk of their earnings and reinvest it back into the business.
Right, retained earnings.
Exactly. So every dollar they keep automatically makes their equity base, the pot of money they work with, bigger for next year.
Okay.
So if I give the managers more money to work with, I naturally expect them to make more total profit. Right. If their profit goes up 10%, but only because I gave them 10% more capital to start with, well, have they actually gotten any better at their job? Or are they just working with more resources?
Got it. That makes sense. That's where that savings account analogy we found comes in, isn't it?
It's really the simplest way to see it. Imagine you start the year with, say, $1,000 in a savings account, earning 5% interest.
Okay.
The dollar amount of interest you earn automatically goes up each year. Simple compounding. First year, $50. Next year, it's 5% on $1,050, so $52.50, and so on.
Right. The total balance grows, but the rate you're earning, the 5%, that efficiency number, it hasn't budged. It's stuck.
Exactly. So just seeing earnings growth alone doesn't prove management is adding new value or getting more efficient. They might just be benefiting from that automatic compounding effect.
And that's why Buffett hammered on about the true measure of efficiency, return on equity, ROE.
ROE, that's the number. It tells you how effectively management is using the money shareholders have left in the company, the equity, to generate profits. It's just profit divided by equity.
So if management actually improves the ROE percentage, that's real skill. That shows they're getting more bang for the buck. If ROE just stays flat,
then they're mostly just riding the wave of retained earnings, just math, like Buffett said.
Okay, let's nail this down with a quick example. TechCo, last year, $100 million equity, $10 million profit. Easy math, 10% ROE.
Right. Now this year, let's say they keep $20 million of that profit and reinvest it. Their equity base grows to $120 million. And this year they make $12 million in profit.
Okay, so the headlines are going to scream, TechCo profits surge 20%. Sounds amazing.
It looks great on the surface, but you run the ROE math again. $12 million profit divided by the new $120 million equity base.
It's a 12% ROE.
Precisely. They look better, but they basically just poured more fuel into the exact same engine. It didn't get any more efficient.
So the takeaway for you, our listener, is crystal clear. Don't get dazzled by just the headline profit growth. You've got to look deeper. Judge the business by its efficiency, its ROE. Is that percentage actually improving?
That's why, back in '77, Buffett made such a point of highlighting Berkshire's 19% ROE. That, he said, was the truly meaningful number. Way more important than the flashy 37% jump in EPS.
And understanding that measurement, that focus on real efficiency, it leads straight into his next big lesson, right?
Yeah.
Because efficiency doesn't matter much if you're stuck in a terrible industry to begin with.
Exactly. You have to choose your game wisely. This is where Buffett learned a really hard lesson about headwinds versus tailwinds.
Yeah, this part of the story is powerful. He realized, maybe painfully, that even the absolute best managers, brilliant people, can ultimately fail if the business itself is fundamentally flawed, if the industry is working against them.
That's the headwind idea perfectly put. His own long, bruising experience with Berkshire Hathaway's original textile division was the classic headwind example. He wrote about the extraordinary efforts, the management cooperation, the hard work.
Yeah.
But the basic economics of the U.S. textile industry at that time were just brutal. They were swimming against a really strong tide, and despite all that effort, they just couldn't generate decent long-term returns.
It must have been tough to accept that sheer effort and smarts couldn't overcome a fundamentally bad business structure, like having the best captain on a ship that's just, well, structurally unsound.
It's a sobering lesson, but then you contrast that with the tailwind business he was building, insurance.
The other side of the coin.
Totally the opposite structurally. The sources point out that even when Berkshire made some pretty significant mistakes in insurance over the years, like a failed expansion into Florida urban auto insurance, or some problems with a surety operation.
Okay, so they weren't perfect.
Far from it. But the overall dynamics of the property and casualty insurance industry back then, that was the tailwind. The fundamental economics were favorable. It provided a buffer. Even with mistakes, the overall results were still pretty good.
So the industry itself kind of helped them along. Like having the wind at your back makes sailing easier even if you're not the perfect sailor.
That's a great way to put it. The prevailing winds were favorable. So connecting this to investing today, you really want to look for industries where the basic economics are working for you, not constantly fighting against you.
So Buffett eventually concluded he'd rather own maybe just a decent business, but one with strong tailwinds.
Then a really struggling business, even if it was run by an absolute superstar manager fighting headwinds every day, the industry choice matters enormously.
And that tailwind business, it didn't just provide that buffer, that insulation. It provided the actual fuel for everything that came next, right? The concept of float.
Oh yeah, float. It's a brilliant, simple concept at its core. It's basically like getting a zero-interest loan from your customers.
How does that work?
Well, insurance customers pay their premiums up front, right? But the insurance company doesn't pay out the claims related to those premiums until sometime later, maybe weeks, months, or even years later.
Okay. So there's this pool of cash sitting there in the meantime.
Exactly. That pool of cash, the money collected but not yet paid out, that's the float. And Buffett realized he could use that float as working capital. He could invest it for Berkshire's benefit.
It's essentially free leverage, money he could put to work in buying stocks or other businesses.
That was the rocket fuel.
Yeah.
Our sources show by 1977, this float engine had allowed Berkshire's insurance premium volume to just explode from around $22 million to $151 million in about a decade, and crucially, without having to sell any new Berkshire stock or borrow conventionally.
Incredible growth, self-funded. Okay, so that raises the obvious next question. He's got this huge, essentially free pool of cash from the float.
Yeah.
How did he decide where to invest it?
Right. And this is where his mindset is so critical. The sources are clear. Buffett doesn't think like a stock trader, buying tickers. He thinks like a business owner. When he buys a stock, he approaches it as if he were buying the entire company.
That's such a fundamental shift for most investors.
Yeah.
Thinking like an owner, not a speculator.
Absolutely. And he had this clear, pretty simple 4-point checklist he applied to every potential investment. It's remained remarkably consistent.
Okay, what are the points?
Number 1, the business has to be something they can fundamentally understand. No black boxes, no complex tech he couldn't grasp.
Simple enough. Makes sense.
2, it needs to have favorable long-term prospects, not just a good quarter or a good year, but enduring economic strength.
Looking way down the road. Okay.
3, critically important, it must be run by honest and competent managers, people he could trust.
The people matter. A lot.
Hugely. And finally, number 4, it has to be available at a very attractive price. He wasn't looking to overpay, no matter how good the business was.
That last one, the price point, is interesting, though. Because he wasn't trying to time the market, right? He explicitly said he doesn't buy based on predicting short-term price moves.
Exactly. In fact, it's almost the opposite. If he'd done his homework and knew the business was good, points 1, 2, and 3 were met, he actually welcomed falling prices.
Wait, Welkered falling prices. That sounds counterintuitive. Why?
Because if the underlying business value is solid, a lower market price just means you get to buy more of that good thing cheaper. More ownership in a great company for the same amount of money. It's buying value on sale,
Ah, okay.
as he put it.
That requires real conviction. And frankly, ignoring pretty much all the daily market noise and headlines.
Completely. Which brings us to the next point. How do we actually do that? How do we ignore the noise day to day?
I mean, what does this mean for practical investing?
Well, Buffett's advice is consistent. Focus on the long-term results of the business, not the short-term fluctuations of the stock price. He even used Berkshire's own history as a warning.
How so?
He pointed back to the textile business again. They had one absolutely blowout year of profits way back in 1948. Huge profits. But that one great year didn't mean anything for the long term. It didn't stop the eventual, inevitable decline of that industry for them.
So one good snapshot doesn't tell the whole story.
Not at all. And similarly, the day-to-day or even year-to-year stock price, like Berkshire, having a big loss on paper in the 74 market crash versus a big gain in 77, that doesn't really prove much about the underlying quality or progress of the businesses Berkshire owned.
So focus on the business fundamentals, the long-term trajectory. Okay, let's circle back to point 3 on his checklist for a sec. Management. You said it was critical. In businesses like insurance, where the product itself is basically a commodity, right? One policy is much like another. Why is management so vital there?
Yeah, this is really insightful. In a commodity business, you don't have a unique product, a strong brand moat, or some killer patent to protect you. Your competitors can offer pretty much the same thing.
So what's the edge?
The only real competitive advantage comes down to discipline, particularly underwriting discipline. It's the quality of the people making the decisions.
You mean deciding which risks to take on and at what price?
Exactly. Superior managers like Phil Leach, who ran National Indemnity for Berkshire for years, they achieved what Buffett called extraordinary results simply because they knew when to say no. They refused to write insurance policies at prices that didn't make sense, even if it meant shrinking the business temporarily.
Ah, so they avoided that trap of just chasing market share, writing bad business just to look bigger. They didn't join the race to the bottom on pricing.
Precisely. That discipline, that willingness to prioritize profitability over sheer size, that was the competitive edge. And that comes entirely down to the quality and integrity of the management.
Which leads to one last really interesting point about ownership, right? He didn't always feel the need to buy the whole company.
Right. This is fascinating. He often preferred just owning minority stakes, sometimes large ones, but still minority stakes, in companies run by managers he considered truly superior, like Tom Murphy at Capital Cities.
Rather than buying the whole company and then having to manage it himself or install his own team.
Yeah. It seems he realized it was often better and maybe easier to partner with existing genius than to try and replicate it or manage it directly. You don't always need control.
So find the right partners, trust them, and benefit from their skill.
That seems to be a core part of the lesson. He could achieve outstanding results through non-control ownership, essentially letting brilliant managers allocate capital effectively within their own businesses, while he focused on allocating Berkshire's overall capital.
Okay, so wrapping this up, this deep dive into just 1 year, 1977, it really lays out the timeless foundation. Focus on real efficiency, ROE, not just headline growth. Pick industries where the wind is at your back, the tailwinds, and think like a long-term business owner, focusing on understanding prospects, management, and price.
The core message, even after all these decades, is still startlingly simple, isn't it? Don't get caught up chasing trends or reacting to quarterly earnings beats or misses. Your real job as an investor is to judge the business itself, the economics, the people running it, not obsess over the daily stock.
So here's a final thought for you to chew on, building on all this. If you actually applied Buffett's 1977 test today, really looking hard at ROE trends, judging management quality honestly, considering the industry headwinds or tailwinds, how many of those companies currently screaming about record-breaking results in the news would actually pass that kind of tough fundamental scrutiny?
That's definitely something worth thinking about on your own.